This is Trade Alive with IUX, where markets come alive and trading gets real. Let's go live.
This podcast is brought to you by IUX Trading Platform, elevating your trading experience. Welcome to Trader's Journey, a part of Trade Alive, brought to you by IUX Education, where we uncover timeless stories and lessons from the world's greatest traders. Imagine this. It's October 1987, a Monday that would become one of the darkest days in financial history. The markets are in freefall. The Dow Jones plunges over 22% in a single day. Traders are panicking, phones ringing nonstop, screens flashing red. It's the kind of chaos that makes even seasoned professionals freeze. But somewhere in the midst of that turmoil, one man sits in silence, calm, analytical, focused. He's not overwhelmed by fear. He's observing it, studying it, calculating how to use it. His name is Andy Krieger, and in just a few weeks, he would make one of the boldest and most mathematically precise trades in modern financial history. A trade that would pressure an entire nation's currency and leave the world stunned at its scale and accuracy. That trade became known as the Kiwi Trade. It wasn't luck. It wasn't gambling. It was pure discipline, a blend of macroeconomic logic, technical precision, and emotional control. Today, we're going to explore how Andy Krieger, a trader in his early 30s, managed to spot what others couldn't, to see imbalance where others saw safety, and to turn one of the world's smallest currencies into one of the most famous trades ever recorded. So, sit back and let's dive into the remarkable mind of the man who challenged the markets and won. Andy Krieger isn't a household name like Soros or Buffett, but among traders, he's a legend whispered about in trading floors even today. Not because of how often he traded, but because of how precisely he did it. Born in the 1950s and educated at Wharton, Krieger joined Bankers Trust in the mid-1980s, right when global currency markets were becoming a battleground of volatility. It was an era of chaos. The world had just seen the 1987 crash, Black Monday, the largest one-day drop in market history. Currencies, commodities, and equities were in turmoil. But where others saw uncertainty, Krieger saw imbalance, and imbalance meant opportunity. His analytical mind and almost machine-like discipline made him different. He wasn't chasing emotion or prediction. He was looking for discrepancies, places where the market's emotion had pushed price away from reality. And that's what led him to New Zealand and to the Kiwi Trade, a move that would make financial history. Because in the months after Black Monday, most currencies had collapsed, but one, the New Zealand dollar, remained surprisingly strong. Too strong. And to Krieger, that meant one thing. It was time to strike. In the mid-1980s, finance was transforming fast. Computers were arriving on trading desks, and information that once took days to travel now moved in seconds. It was an era of innovation and instability, and inside that world, a young trader named Andy Krieger was quietly changing the rules. After graduating from Wharton, he joined Bankers Trust, where his analytical approach quickly set him apart. He wasn't the type to shout across the trading floor or chase momentary excitement. He studied patterns, discrepancies, and human behavior in markets that others called random. To him, every price chart was a story about emotion and overreaction. Then came October 19, 1987, Black Monday. Global markets collapsed. The Dow Jones plunged over 22% in a single day. Currencies and commodities spiraled. Fear ruled every screen. But Andy Krieger didn't freeze. He watched the chaos through a different lens, as data. He understood that when markets panic, prices often move too far from their fundamental value. The weeks after the crash became his laboratory for testing that idea. Scanning the world's currencies, he noticed one that remained remarkably strong, the New Zealand dollar, known as the Kiwi. While most currencies had fallen, the Kiwi stood firm. To many, that was a sign of stability. To Krieger, it was a signal that the market was out of balance. He dug into the data, interest rates, trade flows, and export demand. New Zealand's economy was small and heavily dependent on agriculture, which had been hit hard by the global slowdown. In Krieger's eyes, the Kiwi was overvalued, propped up by sentiment instead of substance. Armed with that conviction, he built a massive position against the currency using options, a method that allowed for controlled risk and high leverage. It was one of the first examples of strategic position sizing at a global scale. At its peak, his exposure was estimated to over $500 million, possibly close to $1 billion, a sum larger than New Zealand's entire money supply at the time. And when the market moved, it moved fast. Selling pressure flooded the Kiwi. The Reserve Bank of New Zealand scrambled to stabilize its currency, but the momentum was unstoppable. Krieger's calculation proved right. The Kiwi fell sharply, and Bankers Trust made an estimated $300 million profit. For most, it was a historic trade. For Krieger, it was the result of logic, discipline, and the courage to act when numbers didn't match reality. Yet the pressure was enormous. Within Bankers Trust, opinions split. Some called him reckless, others called him a genius. Krieger himself remained calm. He wasn't chasing fame or fortune. He was following a principle. When the logic is sound and the risk is defined, courage is a requirement, not a luxury. That trade cemented his reputation as one of the sharpest currency strategists of his time. It also sparked a global conversation about leverage, risk management, and how a single individual's clarity can outweigh an entire nation's momentum. Andy Krieger's story isn't about taking wild risks. It's about seeing beyond emotion, about trusting analysis when everyone else trusts instinct. His success remains a reminder that discipline, clarity, and logic can move markets more than fear ever will. So what made Andy Krieger stand apart from almost every other trader of his time? Why was he able to see what so many others missed and act with such precision when everyone else froze? It wasn't luck. It wasn't aggression. It was clarity. Krieger's greatest strength was his ability to stay logical when others surrendered to emotion. He understood that markets are not just driven by numbers, but by people, and people, under pressure, make emotional decisions. They chase highs, they panic at lows, and they overreact to fear. Krieger built his success on identifying those exact moments of emotional distortion. He once described markets as a mirror of human psychology. When that mirror became warped, when prices reflected panic instead of fundamentals, that's when he moved. He didn't try to fight the market's energy, he redirected it. When traders were driven by greed, he searched for signs of exhaustion. When fear dominated, he looked for resilience. And when the crowd overextended itself, like in the case of the overvalued New Zealand dollar, he found calm and logic. But there was another crucial element behind his success: discipline under uncertainty. Even during the Kiwi trade, when the position size grew beyond what most traders could emotionally handle, Krieger never let the scale cloud his decision-making. He had his parameters, his models, and his thresholds. If the data changed, he would adjust, not out of fear, but because the logic dictated it. This is where the essence of his mindset comes in. Stop loss, not stop logic. To Krieger, a stop loss wasn't a sign of weakness. It was a mechanism for staying in control, a logical boundary that protected his capital and his clarity. He believed that a trader's first job was survival, and survival depended on consistency, not heroics. He also had an uncommon sense of detachment. Most traders tied their self-worth to their performance. A win meant validation, a loss meant failure. Krieger separated his identity from his outcomes. That mental distance allowed him to see reality as it was, not as he wished it to be. His decision-making followed three clear rules. Question everything, even your own analysis. Control your reactions. Emotions are the enemy of precision. And act decisively when logic is clear. Hesitation is often more costly than a loss. While many traders sought excitement, Krieger sought equilibrium. He believed the key to long-term success wasn't about predicting where the market would go next, but about preserving mental clarity long enough to recognize when the market was wrong. And this mindset is what separated him from the rest of Wall Street. Where others equated risk with danger, Krieger saw it as information, feedback from the market that helped refine his models. Where others feared volatility, he saw opportunity in the overreactions it produced. He was relentless in asking one question: does this make sense? If the answer was yes, he held his ground. If it was no, he reevaluated without ego or panic. That constant calibration between logic and emotion, between conviction and caution, was his real edge. In a world where most traders sought to outsmart the market, Andy Krieger simply sought to outthink himself. He mastered not just analysis, but awareness. And that inner discipline, more than any chart or model, is what turned the Kiwi Trade from a bold idea into a historic achievement. Every legendary trader has a philosophy, a lens through which they interpret the markets. For Andy Krieger, that philosophy was built on three pillars: clarity, logic, and asymmetry. These weren't slogans. They were practical guidelines that shaped how he analyzed every currency pair, every move, every shift in sentiment. And they're the reason he saw the Kiwi opportunity long before anyone else did. 1. His core belief: markets overreact always. Krieger believed that markets rarely move in a straight line. Fear pushes prices too far down. Optimism pushes prices too far up. And in the aftermath of Black Monday, the emotional swings were extreme. While most traders focused on the chaos itself, Krieger focused on something else. Where did the market move too far? Which currency reacted irrationally? Which one didn't react enough? This mindset came from years of studying how human behavior distorts price. He wasn't trying to predict the future. He was trying to identify where emotion had created imbalance. And in late 1987, one currency stood out. The New Zealand dollar, the Kiwi, had barely moved despite global turmoil. But Krieger didn't see stability. He saw a currency acting strangely, a currency that was out of sync with global fundamentals. 2. His strategy was analyze the fundamentals until the picture becomes clear. Unlike many traders of the era who relied heavily on instinct, Krieger relied on structure. He dug deep into New Zealand's export data, trade balances, interest rate spreads, global demand for agricultural goods, cross-currency correlations after Black Monday. What he found was unmistakable. The Kiwi was priced as if nothing had changed, even though everything had changed. New Zealand's export-driven economy was vulnerable to global slowdown. Commodity demand had weakened, liquidity was shrinking, and tightening financial conditions made smaller currencies particularly fragile. To Krieger, the numbers didn't match the price. That contradiction, price versus reality, was exactly the kind of imbalance he specialized in. 3. Technical precision, the power of relative value analysis. Krieger didn't just rely on macro fundamentals. He also used advanced technical analysis techniques for the time. One of his favorite tools was relative value comparison, examining how one currency behaves relative to others under the same conditions. After Black Monday, the US dollar dropped sharply. The Australian dollar dropped. The Canadian dollar dropped. Even the British pound weakened, but the Kiwi barely moved. That divergence was a signal, not of strength, but of delay. Krieger understood a simple but powerful truth. If one part of the system isn't adjusting, it's only a matter of time before it does. 4. Position sizing as a strategy, not a risk. There's a famous misunderstanding about the Kiwi trade, that Krieger simply took a massive position because he was confident. But Krieger didn't size big out of bravado. He used options, not direct currency shorts. That allowed him to limit his initial downside, scale exposure strategically, maximize payoff only if the thesis played out, and maintained clarity without emotional pressure. This wasn't about taking a huge swing. It was about structuring a position that reflected a high-conviction imbalance with a controlled risk profile. In modern terms, this was macro risk management far ahead of its time. 5. His execution rule: act when the logic is clear. The final element of his strategy, and perhaps the most important, was his insistence on acting only when the numbers and logic aligned perfectly. He didn't move early. He didn't guess. He waited until fundamentals confirmed the imbalance, technical analysis confirmed divergence, market sentiment remained misaligned, and the pricing of options made the trade asymmetric. Only then did he move. And when he did, he executed with full clarity, full discipline, and full confidence. This was not impulsive. It was not emotional. It was deliberate. The result of that philosophy: these core beliefs, discipline, logic, and recognition of imbalance, set the foundation for the Kiwi trade. While others were trying to recover from Black Monday, Krieger was identifying where the market's fear had created blind spots. While others focused on the chaos, he focused on the currency that should have reacted but didn't. And while others hesitated, he acted precisely when the data made sense. This was not aggressiveness. It was not intuition. It was structured logic, the very heart of the mindset behind stop loss, not stop logic. When Andy Krieger finally pulled the trigger on the Kiwi trade, everything he had analyzed in the weeks after Black Monday came together. Using options rather than direct spot positions, he built a highly leveraged yet risk-controlled short position against the New Zealand dollar. It wasn't impulsive. It wasn't emotional. It was the logical extension of everything he had studied: imbalanced fundamentals, stressed global demand, and a currency that was simply priced too high for the conditions around it. At its peak, Krieger's exposure was estimated to exceed $500 million to nearly $1 billion, a staggering figure considering that New Zealand's entire money supply at the time was smaller than the actual position he was holding. This wasn't about trying to overwhelm a currency. It was about placing a structured bet on market correction, on price eventually snapping back to its true value. And that's exactly what happened. As the selling pressure intensified, the Kiwi finally gave way. The currency fell rapidly, aligning exactly with the imbalances Krieger had identified. By the time he closed out the trade, Bankers Trust earned an estimated $300 million, one of the largest profits ever generated from a single currency position at that time. But the result wasn't just financial. Inside Bankers Trust, the trade became a benchmark for disciplined macro execution. Colleagues saw that Krieger didn't need noise, ego, or adrenaline. Only logic, structure, and calm. On the global stage, the trade shook central banks, demonstrated the influence of modern currency markets, and cemented Krieger's reputation as one of the sharpest macro thinkers of his generation. For Andy Krieger, the Kiwi trade wasn't a lucky strike. It was the outcome of the exact principles we explored earlier: clarity over emotion, structure over impulse, and conviction backed by analysis, not hope. When we look closely at the Kiwi trade, what made Andy Krieger stand out wasn't the size of the position, it was the quality of his thinking. His success came from a combination of traits that worked together with precision. First, he identified imbalance faster and more clearly than others. While most traders after Black Monday were focused on the chaos in major currencies, Krieger was scanning for places where the market had overcorrected. That's how he spotted the Kiwi, a currency that stayed unusually strong despite a weakening global economy. He didn't rely on instinct or headlines. He relied on patterns, data, and the relationship between fundamentals and price. Second, he separated analysis from emotion. Krieger didn't react to market fear, and he didn't follow the crowd's assumptions. His calm interpretation of volatility allowed him to see when prices drifted away from reality. This emotional distance is what made him comfortable taking a position that would overwhelm most traders mentally. Third, he used structure, not aggression. His large exposure wasn't a gamble. It was a structured, option-based position designed to control downside while maximizing the impact of a correct thesis. He didn't take oversized risk, he took efficient risk. This disciplined structuring is what allowed him to hold the position with clarity, even as it grew to historic scale. Fourth, he adapted only when logic changed, not emotion. Krieger didn't hold his trade because of ego. He held it because every piece of new data continued to confirm his thesis. And if that data had changed, he was prepared to adjust. This is the essence of his mindset. Use stop losses to protect capital, but never let emotion override logic. Finally, his conviction came from preparation, not confidence. Before he acted, he had already tested the idea from multiple angles: fundamental, macroeconomic, flow-based, and technical. So when he executed, he wasn't taking a shot. He was executing a conclusion backed by analysis. In the end, Andy Krieger succeeded because he combined three rare qualities: clear thinking, disciplined structure, and the ability to stay logical in a market driven by emotion. The Kiwi trade wasn't just a bold move, it was a demonstration of what happens when preparation meets calm execution. Andy Krieger's story is often remembered for the headline, "A single trader pressures a nation's currency." But his real legacy isn't about the size of the position or the profit it generated. It's about how he thought and why his thinking continues to influence traders decades later. Krieger showed that the most powerful edge in trading is not prediction, it's clarity. Clarity that cuts through panic, clarity that sees imbalance before others do, clarity that comes from preparation, discipline, and a willingness to trust your logic even when the crowd is moving in the opposite direction. His Kiwi trade demonstrated that opportunities often appear when markets lose alignment with reality, not because traders are reckless, but because fear and emotion can push prices too far in one direction. Krieger's strength was recognizing those moments and acting with calm precision. And so the lessons he leaves us with are simple, but deeply practical. 1. Logic first, emotion last. The market will test your patience, your confidence, and your discipline, but your decisions should always follow analysis, never the feeling of the moment. 2. Structure your risk so you can hold your clarity. Krieger didn't win because he took huge risks. He won because his structure protected him enough to think clearly. 3. The crowd is often loud, but rarely accurate. If your reasoning is solid, you don't need confirmation. You need patience. 4. Stop loss is a tool. Stop logic is a choice. You protect your capital with risk management, but you protect your career with disciplined thinking. That combination, clarity under pressure and structure under uncertainty, is what made Krieger exceptional. And it's what any trader can practice today, regardless of account size or experience. As we close this episode, take a moment to reflect. Where in your trading do emotions creep in? Where do you act fast? And where do you hesitate? And how would your results change if you adopted Krieger's mindset of calm, structured logic? If today's episode gave you something to think about, we'd love to hear from you. Share your thoughts, insights, or your favorite moment from Andy Krieger's journey. Your perspective might inspire someone else listening. And if you want to sharpen your skills, deepen your understanding, or practice with structure and discipline, visit IUX Education, where you'll find free learning resources, trading tools, and a demo account to help you grow in a risk-free environment. Thank you for joining me on today's Trader's Journey. Until next time, stay curious, stay disciplined, and keep learning.
You've been listening to Trade Alive with IUX. Ready to put these insights into action? IUX is here to power your next winning trade.